The day trading visual basics system is built on the premise of reversal recognition. Some of that recognition is the obvious gap, up or down, but the primary emphasis is market strength of a movement. And that's identified primarily through indicator line lengths. And so the primary emphasis has always been to identify the strength of a market push, the forces in the marketplace, or the pressures that are making it move. The seven short-term trend lines identify that pressure, but they do it on a little bit slower method than the 22 market force recognition indicator lines. Now, when you think of the strength of a market push, some people will think of just the day that it is occurring. For example, when you have a bottom of cycle pattern, a BOC pattern, basically a V-shaped pattern, but the right leg is higher or lower. When it is higher than the left leg, then you have that BOC higher pattern is a stronger pattern because that indicator line length is longer, and that identifies the strength. But it not only identifies the strength on that day, it typically identifies the strength in the movement, the start of the movement. Because this is one thing that we recognized when we started analyzing strength. We found out that the starts of uptrends were oftentimes stronger, and as a result they lasted longer. So a BOC higher pattern may have an uptrend that's a few days longer than another pattern might have. And when multiple indicators are in the same BOC pattern, that becomes significant as well, because we really don't know how many market strengths or pressures we are tracking. We just know that we have 22 market force recognition indicator lines, and the combinations of how they work together with the different forces can give you an analysis that's different as you examine different opportunities. That being said, you then can identify with the initial strength of an uptrend, or an initial strength in the form of a gap up next day, through those indicator lines that we see. Example, zip red will oftentimes move 50, 70, 80, or 90 points in one day. And sometimes the price barely moves when that happens. But the next day, that's when things really start happening. And so that phenomena of when you anticipate a gap or a strong candle, and you only get a medium or an insignificant candle, or especially if you get a doji, then the following day is when you'll get a big green candle or a gap up, typically. So there's a lot of relationships that occur. The other thing too also is the downforce reaction, or the upforce reaction, and by that I mean you have a top of cycle pattern that is lower. So the right leg is lower than the left leg. It's a TOC pattern, so it's an upside down V, and it occurs at the bottom of a cycle. So a top of cycle pattern occurs at the bottom of a cycle, which is obviously divergent. When that happens, it typically identifies a stock that has been pushed too far. It's just been, the price has been pushed way down, and as a result, the reaction to that is going to be the opposite push up in the form of a gap or in the form of several days of movement in that direction. Price in this case, we're thinking price up several days. In this example, we have we're in NUTR, and the Zion lines are on May 19th, 2017. The trend chart here shows that the trend red, green, and gray are in a TOC pattern, and the power indicators show us that Zip Zion is highest underneath power orange. I said that wrong. Power Zion is highest underneath power orange, and power pink, which is our deep cycle indicator, is lowest at this point. So we're down at a very low deep cycle indicator. Now we also have, I think there's about 14 TOC lower patterns, and there are, I think, 4 or 5, maybe 6 TOC higher patterns. And you might think, like in the price chart over here, we got 3 that are TOC higher patterns. They almost look like a right leg W higher, which is, basically what they are as well. Now, with the first thing that sticks out, you've possibly heard me talk repeatedly about the number one indicator that I look at, and that is trend red. And that's the one we glance at all the time. And trend red is in a TOC lower pattern, so it's been pushed down to, below where it should go, typically, in your thinking. And trend red right now is at minus 38. And now that you might say, well, that doesn't mean, look at all these indicators before where you've had, what are your patterns? Well, if you go the day before, you have patterns, the trend red, green, and gray are going up. So they're obviously not in a down touch scenario, and the gray is going up for several days. And so you don't have a signal here for the last 7 or 8 days. And that really shows up in several places. It shows up in your price green going down under 0. It shows up in your zip green at 0. But the best place in my mind that it shows up is in your swing Zion, right down here. Because remember, swing Zion is a price barometer with swing pink and the 3 price lines, red, green, and blue. Those 5 lines are price barometers, and when the price goes up, the lines go up. And when they go down, the price goes down. And so your price barometer, your swing Zion, has just from way back here about 7, 8, 9 days prior, has just been continually going down, down, down. It didn't move until right here. And on this day, this closed at 28.90. And the following day it closed at 29.05. So it went up 15 cents on that day. But it also made the zip pink line jump off of the low spot. And then the following day it went back down. All of your zip indicators are at 0 except for zip pink. Zip pink on this day is at 5.6. And all Zion, green, blue, yellow, gray, and red are all at 0. And so That doesn't necessarily mean that it's going to bounce up the next day just because they're at zero, but it is an interesting place for them to be. I look more at the strength of the right leg W's that we have, like for example in the price charts and in the swing chart. And if you notice, swing pink and Zion, which are primarily paired together, one's in a a TOC higher, and the other one's in a TOC lower. So their divergence, which again causes quite a difference in what's happening. But the key element you look at what's happening in the, wasn't there a signal in here? And no, in the last 6-7 days prior to this signal, not really. You could say right here you might have a signal, but that it doesn't reflect that in the indicators significantly because of basically what you've got. Yes, you have a W pattern in trend red, but you don't have significant strength in the power lines going down. They are in somewhat of a format. There's several of them that are 3 days down. There's some of them that are TOC 2 days down, and but the associated activity in the other charts don't support what's happening on that particular day. And even though it looks like it could be possible, especially with trend blue at -20, that's pretty significant. It just doesn't necessarily, excuse me, it doesn't necessarily dictate what we like to see for a general pattern location or identification movement within the stock and identify it as a signal. It's just not there. But it certainly comes about in the last 3 days or 2 days prior to this point, because like I say, zip pink jumps off of green, goes all the way up to 28 and then comes back down. You've got zip red that crossed over the 50 line, and that's basically a red peak, and zip yellow's down low, so you know it's coming back down the next day from the day before the Zion vertical line, because this right here gives us that red peak that tells us it's coming down the next day. Likewise, all the rest of your lines in the swing chart, yellow, gray, pink, and Zion are all under zero. And moving, obviously, like I explained, the Zion, that one really triggers it for me when I can see that the price is just continuing to stay low. But bingo, all of a sudden here you get the signal. You've got a trend red TOC lower pattern. That's the number one thing. All of your power lines, you got the power 6 are all under the orange line. That's a example of location pattern ability, meaning that when they're all under the orange line or all over the orange line, they potentially can gap given the right pattern and associated conditions with identical indicators and with the down touches in the trend chart. Basically what you have here on this vertical line day is trend gray is down touched the pink line, and both green and red are down touch underneath the blue line. So it's a key signal, it's a key down touch signal, and that oftentimes is what triggers your understanding. And it goes from it closed at $28 and it opened at $42. So really, really powerful example of a gap up situation. It was just continually driven down and held down, and I think you can only guess, but I think somebody was just getting rid of a huge amount of shares, and in so doing, that sell-off caused the prices to continue to drop. So, excellent example of how a gap up works. This was a little bit different than some of the ones that you might typically see, but the pattern, and if you haven't picked it up on other videos, you've got two things within the proximity group patterns. You have the physical shapes that they're in, like a BOC pattern or a right leg W pattern, and those you obviously need to abide with. But the other thing is that the patterns will, from a location perspective, will appear in uniformity, and by that I mean all six of them will be above orange, or all six will be under orange. You'll have the Zion under orange and the Power 4 above the orange, or a reciprocal situation. You'll have Power Zion down with the Power 4 up. There's just pattern layouts that appear at the same time with the conditions that often justify the gap recognition when we examine the opportunity. So keep that in mind when you're looking at proximity groups, because they're the most important. It's easy to identify and count the identical indicators in 1, 2, or 3 patterns. It's easy to see the down touches, or in the case where you don't have a down touch, you have what we refer to as the sky touch, where trend red and green are typically highest. And oftentimes the red and green separation is strong. I mean, the difference between the two might be 9 or 15 points. Typically it runs 3 to 5 points, I guess I'd say. That separation does. When it gets much stronger than that, that's a good indication for a gap up. Those two are easy to see. The proximity group patterns have a varied acceptable range of groupings, the way the lines are located, and the shapes that they're in. So put those two together, and then there's a few exceptions. Like I've seen Zion and blue and white underneath orange, and then the other lines above orange. It pushed it down, but it didn't get pushed down far enough. The price didn't, and so all the lines didn't move down underneath, and that gapped up real nicely. So there's a variation to it, but after you begin to look at these things and you see them time and time again, you begin to recognize this. And that's one of the best things that you can do, is to just go to your hot lists, find your gaps, mark them down, and then go through 2 or 3 every day and become familiar with how they look. And just that repetitiveness of identifying how they look will give you great insight into mentally saying, hey, this is a gap. Because as long as you have the 3 together, you got to have the indicator count, the identical indicator count, and you got to have the down touch in the trend chart. Or that sky touch example that I use, you got to have that or the down touch. There has to be one of those in the trend chart, or it might not work. And then you need to have the patterns within the 7 patterns of the proximity group, and then the repetitiveness of seeing the location of the power 4 and the Zion line in relation to the orange line. So it's after you've looked at a number of them, it soon becomes relatively easy to identify how the gap is going to look, and then it gets exciting because because you now discover that you can become very knowledgeable. You can we all treat ourselves or think of ourselves as independent. But having independence doesn't mean you're successful. But when you are independent, thinking independently, and not dependent on someone else to tell you what's going on, like many systems out there, they have an algorithm that says, well, okay, it's time to buy, and you have absolutely no idea what it's going to do. You just hope and pray that it's going to do what it says it's going to do on that day. And they just shoot on the numbers. The algorithm works 87% of the time, or whatever that ratio is. We decided from way back, I personally decided that I had to be able to have some kind of method, system, procedure, or whatever you want to call it. I had to have a way to look at what was happening in the market relative to each stock and tell myself, well, that based on what I see, that stock is going to move up or down, or we're going to see gaps, or whatever it is. And so the procedure that you go through in analyzing the different opportunities, that procedure is, we refer to that as the procedure power, because we've got the super indicators, super sensitive indicators, which are the indicator power, the formula power, which is the patterns and the verifying the good conditions and buying and selling on the signal or with the signal for that pattern. We've got that, and the procedure is the analysis of those opportunities that you have, verifying the good conditions. If they don't have good conditions, you don't buy it. And that procedures process, when you look at it through the indicator lenses, when you look at it through those indicator glasses, you can see what's happening. And it's exciting. And that's what this whole thing is all about. Because when your confidence builds and you become excited about knowing that the indicators are telling you there's going to be a high probability that that's going to occur. And when we say high, we mean 95, 98%, 99% of the time. And that just sounds crazy to some people. But it's true. And it's true because we in that example you may have heard me use before, you take 10 patterns, and I think of 10 right leg W patterns. You can look at the varied conditions that go along with each right leg W pattern, and you can pick out the 2 or 3 that are going to react the best. And those become the 2 or 3 that you choose. We hand pick the ones that we want. And that's why through that selection process with good conditions, your ratios of high probability are 98, 99%. Not, normally high probability might be 70% or 75%. Excuse me. So, needless to say, it is exciting. Hope you have a chance to listen to more videos. Become familiar with the proximity group patterns. That's probably the most important part of searching and finding gaps.